For years we were led to believe that banks simply store our money and then lend it to other people. A kind of middleman that receives savings from one side and provides loans from the other. But the reality is far more unusual. Most of the money we use today was never sitting inside a vault. It was never created in a money printing factory. In many cases, it appeared at the exact moment a bank approved a loan. A person requests money. The bank agrees. It enters an amount into a computer, and within seconds that money appears inside a bank account. $10,000 that did not exist before can now be used to buy, pay, or invest. And if this seems impossible, it is because for a long time we were taught a different story. We believed that money could only be created by governments or central banks. That behind every banknote there had to be something physical supporting its value. But reality is different. Most of the money that exists today is not bills or coins. It is simply numbers inside bank accounts, created mainly when private banks issue loans. And understanding this completely changes the way we see money. Because credit is not just a debt. It is one of the most powerful forces driving the economy. To understand it, we first need to know the three main types of money. The first is the money banks use to conduct transactions between themselves. We never use this money directly. The second is cash, the bills and coins we carry in our wallets. But here is where something surprising appears. Cash represents only a small portion of all the money that exists. The majority exists digitally inside our bank accounts. And that money appears when a bank grants a loan. Now the most important question arises. If banks are not simply taking someone else's money and lending it out, where does that money actually come from? The traditional explanation says that people deposit their savings. The bank keeps a portion and lends out the rest. But that story does not fully explain how the modern financial system works. Because if banks needed our deposits in order to create loans, they would compete desperately to obtain our money. They would offer high interest rates to attract our savings. But normally the opposite happens. Banks do not need to pay large amounts to receive deposits. So the real question becomes, if borrowed money does not simply come from someone else's savings, how does it appear? The answer lies in something very few people understand. When a bank approves a loan, it does not first search for that money inside a safe. It creates it through a simple accounting entry. For example, the bank records that a customer owes $10,000. At the same time, it places those $10,000 into the customer's account. For the bank, there is a debt that it expects to receive in the future. For the customer, there is money available that can be used immediately. The money appears because there is a promise to repay it. That is the relationship between credit and money. But now the most important question appears. If banks can create money when they issue loans, what determines how much money they can create? The answer is not only about how much money they have stored. It depends on a much more important decision: who they choose to lend to. Because the true power of credit is not only in creating money, it is in deciding where that money flows. And that decision can change housing prices, business growth, and the economic future of millions of people. The Bank of England is not the only institution that explains how this system works. In an official document published in 2014, this institution confirmed something that many people do not know. When a bank grants a loan, it normally does not provide money that was already stored somewhere. Instead, it creates a new deposit inside the customer's account. At that moment, new money comes into existence. In other words, when a bank approves a mortgage or a loan, it does not need to take physical bills out of a vault. It simply increases the balance of an account, and that money begins to exist within the economy. Now let's return to your loan. The money appears in your account, and you can use it like any other money. But that loan has two different parts. The first is the principal, the amount the bank created and placed into your account. The second is interest, the additional money you must pay for using that loan. For example, if you receive $10,000 and eventually pay back $12,000, those extra $2,000 are the cost of borrowing. But here is where something interesting happens. When you repay the original $10,000, that money does not go to another person and it does not sit inside a vault. It simply disappears from the system. The same mechanism that created that money when you took the loan now removes it when the debt is paid. Banks do not only create money, they can also make it disappear. To understand this better, imagine that a bank gives you a car that does not actually exist. The moment you sign the contract, that car appears for you. You can use it for years, and every month you make a real payment for it. But when you finish paying and return the car, it disappears as if it never existed. The only thing that truly existed were the payments you made. Something similar happens with money created through a loan. It appears when you sign an agreement and it disappears when the debt is fully repaid. But the interest you paid remains. And here we return to the most important question. If a bank can create money simply by issuing loans, who does it decide to give that money to? Because the real power is not only in creating money, it is in choosing where that money goes. And the answer may surprise you. It does not always go to the person who wants to start a business or create something new. Imagine two different situations. You walk into a bank and request $50,000 to start a small business. You will probably need to prove your income, provide documents, explain your project, and accept a higher interest rate. Now you walk into the same bank and request $400,000 to buy a home. The situation changes. Why? Because to the bank, a home represents collateral. If a business fails, recovering the money can be difficult. But if a person stops paying a mortgage, the bank can take ownership of the property. From the bank's perspective, lending money to buy a house often appears to be a safer option. So, if you were running that bank, where would you place the newly created money? The answer seems obvious: into loans backed by property. And that is exactly what happened for many years in several countries. Loans for buying homes grew rapidly, while credit for small businesses moved much more slowly. The new money created by banks began flowing mainly toward assets that already existed: houses, properties, and other goods. And when massive amounts of money compete to buy a limited number of homes, something inevitable happens. Prices rise. Many people believe houses become more expensive only because there are fewer homes available or because there are more buyers. And those factors do play a role. But there is another element that receives far less attention: the growth of credit. Every new mortgage creates new money that enters the housing market, increasing competition for the same homes and pushing prices higher. This is why many people feel that, even though they work harder and put in more effort than previous generations, buying a house seems increasingly difficult. It is not necessarily because they are doing something wrong. It is because the rules of the system have changed. And understanding how credit works is the first step toward understanding why today's economy operates the way it does. The problem is not simply that banks can create money. The real question is, where does that money ultimately end up? Because the same mechanism can produce completely different results. Imagine two scenarios. In the first one, a bank creates a $1 million loan for someone to buy a home that already exists. That money goes to the seller, who now has $1 million in their account. But if we look at the economy as a whole, what was actually created? The house is still the same. No new company appeared. No workers were hired. No new products were manufactured. The property simply changed ownership. The problem begins when millions of newly created dollars enter the market looking for the same homes. There is more money chasing the same limited number of houses, and as a result, prices begin to rise. Now imagine a second scenario. A bank lends that same $1 million to a small business owner. He uses that money to hire employees, purchase equipment, and create new products. Now something different happens. The economy produces more. New jobs are created. New services and goods that did not exist before enter the market. The money was used to build something new, the same banking system, the same money creation process, but two completely different outcomes. One can increase the price of existing assets, the other can strengthen the real economy. So an important question appears: if lending to businesses can create more economic growth, why don't banks always do it? The answer is found in the numbers. For a large bank, processing a small business loan can require almost the same amount of time and effort as approving a much larger loan for a major corporation. The paperwork can be similar, but the potential profit can be completely different. That is why many banks end up focusing on larger and less risky operations, while thousands of small businesses struggle to obtain the financing they need. And this matters greatly because a large portion of new jobs are created precisely by small businesses. When money does not reach the people who are trying to build new companies, many opportunities simply never appear. The economy loses potential growth while other markets, such as real estate, continue expanding. But this raises another question. Is there any country that has used the banking system in a different way? The answer may surprise you. China. When Deng Xiaoping began economic reforms in 1978, he tried to understand how other countries had achieved such rapid growth. One of his conclusions was that a single centralized system could never fully understand the needs of every community. That is why he encouraged the creation of thousands of small banks, local banks, and rural financial institutions. The idea was simple. A bank close to a community understands small business owners better than a massive bank managed from a distant central office. Over the following decades, China experienced one of the greatest periods of economic growth in modern history. It did not eliminate the creation of money. It changed where that money was directed. And that is the part many people never discover. Because understanding how credit works does not only explain how money is created, it also explains why some people have more opportunities than others. Now let's leave banks, loans, and numbers aside for a moment. Let's think about something even more important: your time. Every day you work, you are exchanging a portion of your life for money. The hours you spend away from your family, the mornings when you wake up earlier than you want to, the nights when you continue working while others are resting. That time never comes back. That is why money represents much more than simple numbers. It represents a portion of your life transformed into something you can exchange. So when the system creates more money and changes the prices of the things you need, it does not simply change numbers on a screen. It also affects the value of the time you have already spent working. And that is why understanding credit is so important. Because we cannot change a system we do not understand. The first step toward change begins when we stop seeing money as something simple and start understanding how it truly works.